So that's what the loan started out at. I do 15-year loans, everything I do. That's another thing. Everybody talks 30-year loan, 30. They say, well, you get more cash flow. Well, yeah, but you know, if you sit down and look at the difference in the money you're paying, maybe you're getting $100 more a month right now on a 30-year loan. If you're not living off of that money, get it paid down, reap the rewards. If you're 29 right now and you do a 30-year loan, you're almost 60 before it's paid for. But I'm going to call it, say you're 30, you do 15, you're 45. Look how many years you got that full money coming in, plus you can grow with it. And, you know, you look at amortization schedule and look at the difference.
Yeah.
It's not that much. I mean, it's usually on a 15-year loan, you get a better rate than a 30. Plus, that's why I always push to get a good deal. When you get a good deal, that help offsets that.
That's a great point. That's a great point. You know, and it comes back a little bit. I've seen a lot of people show, you know, I look at these as an agent, right? Amortization schedules all the time. And, you know, there is a drastic difference. And like you said, you know, a lot of times we get caught up in not wanting to delay our own gratification, right? People want to live off, you know, money instantly, but somebody like you who is in it for something greater than just money. You know, you love real estate. You know, you've talked about it repeatedly. You don't want to retire, right?
Right.
It's a lot easier, and I'm very similar. Like I'm constantly delaying gratification and pushing things back to just throw things, but you know, throw double payments on a mortgage. You know, my wife and I do things like that, and it is, you know, a lot of people don't want to do that. They want to live off the money now. They want to, you know, buy the car and stuff. But that is a great point. You can save a lot of money on a 15-year mortgage, you know, long term if you decide to go that route.
Yeah, and you know, most commercial loans, they're going to look at it. Some of them now would do 7-year fixed. Most of them it's a 5-year fixed, amortized over 15, 20. A lot of them won't do a 30-year am, you know, 20, 25, maybe the longest the banks would do a lot of times on commercial banks. Not saying all of them, I'm just talking about kind of a rule of thumb. You know, some of them would do different, like, you know, credit unions would do 5 loans and do different. Everybody's a little different, but you're just running like kind of a standard thing, 15, 20, 25 years is what they look at. But it makes a big difference, excuse me, because if you have a job and this is not what you do full time, well, you can afford to let that thing pay down. I mean, you know, and I'm not a big one. I don't double up on payments. If I'm gonna double up, I'm gonna be paying it on something else. I won't, you know, I want more, you know, when I was building my, and see, it's something else I hadn't even touched on in 2000. So we come out of the recession. Sorry about that. We come out of the recession, you know, recession was 2008. Well, in 2011, here where I live in Tuscaloosa, we had a major tornado that I lost total 26 rental houses and had damage to probably 70 other ones. And there were probably 7,000 something structures destroyed here in this town. So it took me a little while to, even though I had insurance, I had to deal with that for 3 years, you know, before I got to find all the money. So you lost houses, you lost income. So you slowly building back. I didn't build them back. I went and bought more. A lot of people don't understand that you can do that with insurance. You know, they might try and make you think if you don't build it back, they hold what they call recoverable depreciation. So like if you got a rental house and it burns and your company says, okay, well, if you don't build it back, we're only going to, like I'll give you a good example. I had one that burned a while back with $64,000 worth of coverage. They held 24,000 for recoverable depreciation, but I wasn't gonna build it back. But I done learned enough through the tornado deal. I said, well, that's, you know, I'll just go buy another house. So how long do I have? They said, well, in a reasonable amount of time. Well, what's a reasonable amount of time? I mean, they're not used to getting that kind of, they don't want you to know these things, see. So I went and bought another house. The house I bought, it had to be worth the 64,000 minus the land of the one I bought because I still had the land on one I had to fire. I get the rest of my money then, so I get my 24,000. Wait about 6-7 months, now I'm building the house back. I'm remodeling it back. You know, it wasn't, they told it, but hey, it wasn't that bad as a kitchen fire. But you know, I'm in the construction business, so when I get through with it, I'll have about 30,000, a house free and clear that I rent for $675, You know, it's just, but they try to make, you know, you just don't take everything just because they tell you.
Mm-hmm.
You know?
Mm-hmm. Yeah, no doubt about it.
People are bad about that, you know. I mean,